welcome to this lesson. And today we are going to discuss one sole proprietorship, another one question and answers. And here we have given the question and question in the link below the description. So you can go through the question and thereafter you can attempt this answers. Try to so here try to answer. We will try to answer these question answer for this question, and additional we will say they have given one trial balance, right? Trial balance, and they ask us to prepare a, what you call uh, they have asked us to prepare one balance sheet. Okay, balance sheet and profit and loss account. So say petty cash trial balance 15,000. Okay, 15,000. Right, we have gone through the trial balance and we have put the balance here. Right, I have prepared the balance. I have taken all the balances to T accounts from the trial balance. Okay, so I have taken all the balances to T accounts. Say land cost, buildings, and motor vehicles as per the trial balance. Now we try to answer the questions. Requirement, first of all, you go and see the requirements. In the requirements, they have said income statement for the year ending 31st 3rd 2024, right? And statement of financial position as at 31st 3rd 2024. So shall we answer the shall we go for the first of all, we have taken all the trial balances to the T accounts, and now we will go through the what we call additional information. When preparing the financial statements, to the following adjustments must be taken into the account. First adjustment is the cost of stock as at 31st 3rd 24 was 120,000 with the net realizable value of 100,000, right? And stocks, closing stock, right? Closing stock, you say closing stock, this is how much? 100 and with the net realizable value of 100,000. They said the 120,000 stocks, 120,000, right? Stocks, closing stocks, right? Here another, for this is for the balance sheet. Okay, another closing stock we have to open, right? For the trading account, closing stocks, stock is closing stocks for the trading account, right? That is for closing stock balance sheet. Okay, balance sheet 120,000, right? And this is the net realizable value of the stocks is 100,000. Then we have to say 20,000 debited to credited to closing stocks balance sheet, right? 20,000, right? How can you say trading account, profit and loss account, 120,000, and this will go to the uh, other expenses, right? Closing stock valuation, 20,000, right? Right, the difference is 20,000. First adjustments we have made, that is trial balance, closing stocks, opening stocks is 20,000, right? 120,000, and closing stocks of the trading account, balance sheet account 120 debit, and trading account 120, and 20,000 difference we have credited to the closing stocks balance sheet, and debited to the other expenses in profit and loss account. And number two is building and motor vehicles are depreciated at uh, 10%, right? Buildings and buildings costing 800,000, right? We have put building depreciation 800 means 80,000. This depreciation account debit 80,000, right? Accumulated depreciation, right? Accumulated depreciation of building credited to 80,000, 80,000, right? Depreciation, right? And balance is 800. No? On the 800 we had to calculate the 10%. 10% is 80,000. 80,000 you have to add it to the 160,000. Next one is, this is motor vehicle also 10%. 10% opening balance 1,200,000. From 1,200,000, 10% is 120,000. That has to be to the depreciation account, right? Depreciation account, motor vehicle accumulated depreciation 120,000. Depreciation account debit and credited to the accumulated depreciation account. Okay, have you understood? Depreciation and accumulated depreciation, you know the double entry, no? Depreciation account debit and accumulated depreciation is credited. That here debit and credit, debited and credited. Okay, and debit and credited. Okay, and now go to the third adjustment. Third adjustment, they says the employee's contribution towards the employee's provident fund is 10%, while the employee's contribution is 15%, right? The employee's trust fund ETF is rate to provision 3% rate. Provision has not been made to the current year. EPF and ETF, we have to open a EPF and ETF account. EPF payable, EPF, EPF payable, and ETF payable. First, ETF payable, and ETF account and EPF account. ETF account, ETF, ETF expenses, right? And EPF expenses, EPF and ETF expenses. This is EPF expenses and this is ETF expenses. You have to open an account, right? This is, so wait a minute. This is 15% employers contribution and 10% on the provident fund. Net, they have mentioned the sale, what you call the salaries and wages, right? Salaries and wages. Where is the salaries? Net salaries. They have mentioned here net salary. Net salaries in the sense we had to make it a gross, right? Right. Net in the sense This is the 90%. This is 90%. Okay, 90%. So we have to calculate the net. Net is, if it is 72 is 90% into 100, 80,000. 80,000 is the net, right? Expenses should be 80,000, right? So for the PNL, right? PNL, we had to make a 80,000. We had to show 80,000, right? We had to transfer it 80,000, right? But here we haven't transferred it. We have made it this thing. So we had to say 8,000 EPF. EPF, employees contribution. This is the EPF payable. It will go to the EPF payable, right? It is the salaries and wages. Salaries and wages, right? Wages, right? How much? 8,000. This is the employees contribution. In the EPF, employee contribute 10% and employer contributes 15%. So if it is 10% 18 and 12% is employer's contribution. That is EPF debit, right? EPF expenses debit 12,000. ETF payable, ETF payable creditor, right? EPF, ETF payable, EPF account, right? Payable 12,000, right? If it is a 10% deducted from the employee's salaries, for that only we have made the adjustment, because they have said the net salary. It is the net salary. Then we had to make it to the gross salaries. Gross salaries is 80,000. Because net in the same 90%. This is the 90%, right? 72 is the 90%. So we are making to the net 80%. So 100%. 100% is 80,000. From that 10% is 8,000. So 8,000 payable ETF we have to payable. So double entry is over. And next is they said EPF contribution to the contribution by the employee. That is the expenses for the business. So EPF account debit and EPF payable credit. And thereafter they says 3% is on 3%. Now 3% is the ETF contribution actually made by the company, right into 0.03, 2,400, right? ETF account debit, right? 2,400. ETF payable, ETF payable account, right? Credited ETF account, ETF, right? That is 2,400. It is payable, right? It is payable to the ETF department. That is ETF normally not deducted from the employee. Employer contributes to the ETF department 3% of the gross salary. Then gross salary is 80,000. 80,000 on 3%, 2,400. So ETF account, since it is expenses for the company, for the business entity, we are making the debit entry ETF expense account and credited to the ETF payable account, right? So we have made the entry for depreciation and as well as employees contribution towards employees provident fund and ETF fund, right? And fourth, purchase and sales include 15% VAT. All purchases and sales are on credit basis. Where are the purchases and sales? Purchases and sales, here they say sales 920,000 and purchases 845,000, right? All the purchases and sales were include 15% VAT. All purchase and sales includes means this is the gross. This is gross. This is gross. 115%, right? 115%. 15% VAT. No, this is also no, not the debtors. Sales. This is 115%, right? This is 115%. Includes seller. Sales also include 115%. 115%. Okay. So we have to calculate the 100%. Right? Sales should be 100% because we have to enter the sales, gross sales only, not the net sales. We have to enter the sales account. The sales amount should be gross, right? Other balance should go to the other account, right? So sales we are making, if it is 150, 920 is 115%, then into 100, right? 920 divided by 115, right, into 100. 800,000 is the sales. Actual sales made is 800,000, right? Carried down balance should be 800,000. Carried down balance should be 800,000. Right? Brought forward balance should be 800,000 to the P&L, right? 920. Right? 920. VAT portion we have to exclude it. Exclude the VAT person. VAT portion, right? VAT payable, right? VAT payable 120,000. VAT payable account. Where's the VAT account? VAT account is there. VAT paid, right? This is we have to make it as a payable, right? VAT paid, right? VAT payable account, right? VAT payable account is credited by sales 120,000. 120,000 you have to say sales 120,000, right? Because sales, they say sales is gross, right? Sales is gross. You know why? Because they sales is gross 115. Sales include the VAT portion of 115%. VAT portion of 15%. Sales and purchases. Then discount includes say if the sales is 100%, we have to add the 15%. 115% is the 920,000. So we have to take the 100%. So 100 cost is actual sales is 100, excluding the VAT is 800,000. So we had to take the 800 to the sales, and 120,000 is a VAT portion. So 800 into 15% is 120 is the VAT. VAT we had to transfer it to the VAT payable. It is payable to the our Indian Revenue Department, right? So we have to make a credit entry to the VAT payable. Likewise, to the purchases also, 345,000 is 115%, right? Then into 100. This is 300,000. Actual sales was 300,000. Carried down balance should be 300,000. Actual purchases should be 300,000, right? So this 300,000 only we have to transfer it to the, we have to show it in the profit and loss account. This 300,000 only. Also brought forward balance should be 300,000. So we had to transfer this to the VAT account, VAT payable, right? 45,000. To the VAT payable account, we are going to debit it to the VAT payable 45,000, right? 45,000. 45,000 VAT. That is purchases. Purchases. Purchases 45,000. Okay. Understood? Do you want any workings? We say sales. Sales. S-A-L-E-S. Sales. Right? Here we say sales. This is purchases. Purchases. Here they say, okay, this is purchases and sales. Right? Purchases and sales. They sales. This is the as per trial balance. They says 345,000 purchases, 345,000 purchases, and sales is a 920,000. 920,000. This is includes VATs. That means 115%. So what is the 100%? Actual sales. Actual sales. Actual amount. Actual amount should be 800,000. Right? This is 300,000. Right? 100%. What is the VAT portion? VAT portion is 120,000 and here is 45,000. This is the VAT portion, right? This is the working. This is 115. This is 100. This is 50. This is simple work. Just go through it, right? So VAT account we are removing from the sales account as per trial balance is 920,000. So actual sales is 800. It should be 800. We are removing the VAT portion because it includes VAT portion 120,000. We are removing the VAT account to the VAT account, transferring 120,000 to the VAT account payable, sales account debit. Purchase account in the purchases 45 in the 345,000 includes VATs. So removing the VAT portion 45,000, it is to the VAT payable account debited, and balance should be for 300,000. Actual purchases is 300,000, right? So bad debts of 5,000 must be written off, while a provision for bad debts has to be made for 10% on reminder. Bad debts, right? What is the where is the bad debts? Bad debts, where is the bad debts balance? Trade debtors and bad debts. Trade debtors is 105,000. Out of 105,000, this says bad debts should be 5,000, right? Bad debts, trade debtors 5,000, debit 5,000, right? Trade debtors debit 5,000 and credited to the trade debtors bad debts, debts, right? 5,000. So that adjustment we have made. Bad debts account debit because we cannot recover that 5,000. So bad debts account 5,000 and trade debtors 5,000 credited, right? And bad debts debit and credit to the trade debtors account, right? And they says 10% they have made a 10% provision on balance remaining balances we had to balance it down, right? Remaining balance carried down 100,000. This is 105,000. That this is 105,000. Right? This is here brought forward 100,000. In the 100,000, 10% is the provision. Right? Provision for bad debt. Bad debts account debit 10% in the same bad debts account provision for bad debts. Bad debts is 10,000. 10% on the 100,000. 10% is 10,000, and provision for bad debts you say 10,000, right? Bad debts, right? Bad debts, right? That is the bad debts account provision. If you, when you are making the provision, bad debts account debit, provision for bad debts it's a credited, right? Okay, understood. And in the sixth adjustment, they says administration expenses include 3,000 insurance paid in advance. So administration, other administration expenses include 3,000 of insurance. Insurance prepaid, right? Prepaid amount, right? So we have to transfer this account to prepaid account, right? Prepaid account. We have to open a prepaid account, right? So here we are lacking from space. Here we will say prepaid account, right? This is the prepaid account, right? Prepaid insurance, right? Here we will say prepaid insurance runs. Prepaid insurance is debited 3,000, right? Debit to 3,000. Admin expenses, other admin expenses. Admin expenses. This is carried down. We had to make it to carried down, right? Right. So brought forward 3,000. Right. So prepaid insurance. So those are the adjustments we have to make. Right. Now we have to transfer all the balances. Right. Transfer. You have to calculate like this. You have to close the T accounts. Right. Carried down. Right. Right here 100,000, 1,000,000 and 1,000,000, right? Brought forward 1,000,000, right? Here you will say land. Here you will say cost, accumulated depreciation, net value, net amount, right? Here land, this is 1,000,000, this is the cost, 1,000,000, 1,000,000, right? Buildings, this is 800,000, 800,000, right? Motor vehicle, motor vehicle 1,200,000, right? You have to balance it here, carry it down 800, right? 800, 800, brought forward here 800, right? Like that, motor vehicle also carried down 1,200,000 and brought forward 1,200,000, right? Like that you have to balance it, right? And here accumulated depreciation 240,000, right? This is carried down 240,000, 240,000, brought forward 240,000. Here also 360,000, right? Here 360,000, 360,000 carried down balance. Here brought forward balance is 360,000. Okay. So accumulated depreciation For building, he says 240, right? And to the motor vehicle 360,000. So net value is 560,000, right? Building is 560,000. Here it is 840,000, right? 840,000. So depreciation will go to the profit and loss. Profit and loss buildings 18,000, 80,000. That will go to the balance sheet. So what you call admin expenses. Depreciation buildings. Buildings 80,000. You'll have to say 80,000. And what is called depreciation for vehicle, motor vehicle, P&L, profit and loss, you had to transfer 120,000, right? Depreciation, selling and distribution, motor vehicle, depreciation, motor vehicle, how much this is? 120,000, right? 120,000 we had transferred to the profit and loss account. Now you will charge to purchase account is 300,000. Purchases account 300,000, right? Purchase account 300,000. Sales, next one is sales 800,000. Sales is 800,000. We have taken to the income statement, that is sales is 800,000. We have taken this one also, we have taken, not carried down. This is not a carried down. This is not a carried down. We have to charge it to the profit and loss account. Profit and trading account, account trading account, right? So here opening stock we had to transfer it to the trading account is 30,000, right? Opening stocks 30,000, you are adding here opening stock. And thereafter what you call bad debts, you had to take the trade debtors, right? Trade debtors, it will go to the under the current assets, right? Trade debtors, debtors, debtors is 100,000 value, right? You have to take the bad debts account. Bad debts account is profit, and it will go to the profit and loss account 15,000. Bad debts, right? 15,000. Then in admin selling and distribution, under the selling and distribution you have to say bad debts. The bad debts is 15,000. And thereafter you have to see the provision for bad debts, right? This is carried down balance 10,000, provision for bad debts, and brought forward balance provision for bad debts is 10,000. This provision and bad debts you have to deduct it from the current assets, right? 100,000 is the debtors, and what we call provision for bad debts is 10,000, right? You have to deduct this provision for bad debts is how much? 10,000. You have to deduct it from this amount. So sorry, we had to work it out here, and 10,000 deducted, right? So the balance value is 90,000. 90,000 is the balance value, okay? And thereafter provision for bad debts also we have made it, okay? Trade debtors carried down balance 230,000, right? Brought forward balance is 230,000. Trade creditors will go under the non-current liabilities. Creditors is amounted to 230,000. And net salaries and wages goes to P&L, right? That is 80,000, right? 80,000. Then salaries and wages will appear under the administration expenses. Salaries and wages is salaries and wages is PNL 80,000, right? 80,000 salaries and wages also 80,000. So other administration expenses goes to PNL, that is 20,000, right? 20,000. Then it goes to 23,000. It comes to 23,000. 23,000. You will debit it to other administration expenses. Other admin admin expenses. Admin expenses is 20,000, right? 20,000. And other one says other bank loan carried down balance 100,000, right? Brought forward balance 100,000, right? Other, it is non-current liabilities, that says 12% on bank loan is 100,000, right? Bank loan is 100,000, right? 100,000. This is 12% on bank loan. 12% in the sense interest account, bank interest account is 12% means 12,000. 12,000. That is interest expenses, right? Interest expenses is 12,000. That will appear under the financial expenses, and interest payable will appear under the current liabilities. Interest payable is payable is 12,000, right? Payable also 12,000. What is the double entry for interest payable? Because they have not mentioned interest paid anywhere, right? From here only we are identifying that they have mentioned 12% bank loan, means 12% bank loan means we have obtained a loan from the bank for 100,000 at the rate of 12% interest per annum. So we have recorded the payable amount for the as a current non-current liabilities as loan, and we have to make a provision for 12% interest payable, right? Interest payable, what is the entry? Debit interest account, that is coming under financial expense. Debit 12,000 and interest payable is credited 12,000. Double entry is halas, right? Finished. That is the entry we have made it here, right? And bank loan interest paid, sorry, not payable is not 12,000. Paid is payable is interest. Bank loan interest is payable. Interest account is 12,000, right? 12,000, right? We have to make it here. Open another account down. Bank interest and interest payable, right? Interest payable is 12,000. Interest paid is 12,000 debit, right? That is payable account. And P&L account we are charging to 12,000. P&L account paid is 12,000, right? Payable, and payable is 12,000 minus 12,000, 9,000, right? Carried down 3,000, right? Brought forward is 3,000, right? Here interest payable we have to show 3,000 only, not the 12,000, right? They have mentioned 9,000 we have paid, interest paid. So what is the payable amount is 8% on the bank loan, 12% on the bank loan. 12% of the bank loan is 12,000. That will transfer to the P&L 12,000, and interest payable is 12,000. Out of 12,000, they have paid. They have given in the trial balance that interest is paid 9,000. Then balance is 3,000 payable. So we have made the entry. That interest also we have made it. And donation P&L 2,000 donation account. Donation we can say other expenses. Donation account is 2,000, right? 2,000, right? And cash in hand, this will go to the balance sheet, 130,000. Brought forward 130,000, and cash in hand goes to the current assets. Cash in hand, cash 130,000, 130,000, right? 130,000. Okay, and discounts account will go to the discount account. This will go to the P&L discounts, right? Discount given, right? Trade discount given, discount given, allowed. How much? 2,000. Discount allowed is 2,000, and discount received. Discount received, right? This is received. Allowed. At discount received, this goes to P&L. That is 14,000, right? Discount received. Other income 14,000. 14,000. Discount received. Discount received. Right? That is 14,000. That also we have the advertising P&L expenses 6,000. Right? Advertising comes to selling and distribution. Advertising expenses 6,000. Right? Advertising expense 6,000. VAT payable. VAT payable. How much? 120,000 carried down, brought forward 50 and 70,000, and 50,000 is VAT payable. 50,000 is VAT payable, right? VAT payable is current liability. VAT payable. VAT payable is 50,000, right? VAT payable. And capital account, this is capital account. You say here capital account 2,100,000. 2,100,000. This is carried down. 2,100,000. This is brought forward 2,100,000. Okay, that we have taken in. Closing stocks 120,000. Right? Closing stocks. Stocks is carried down balance is 100, right? And brought forward is 100. Brought forward is 100. Okay, brought forward is 100,000, right? And that is okay. And closing stocks in trading account 120,000. Closing stocks 120,000. right? 120,000. And petty cash carried down 15,000, right? Petty cash brought forward 15,000. Petty cash 15,000, right? That also we have taken. Next one is closing stocks of ETF expenses. ETF expenses, EPF, EPF, and ETF. ETF is 2,400. 2,400. It is PNL 2,400, and ETF expenses PNL 12,000. ETF EPF 12,000, right? Just balancing the accounts only, right? And payable accounts 20, carried down 20, brought forward 20,000, right? Payable current liabilities ETF payable, EPF F payable. EPF payable 20,000, ETF payable 2,400, right? Here carried down 2,400, brought forward 2,400. That's all the accounts we have balanced, right? All the T accounts we have taken in to the profit and loss and balance sheet. Now we can do the balancing part, right? This one is 330, 330, 330,000 minus 120, it is equal to 210,000, right? 210,000, right? 210 means 590,000 is the profit. Gross profit is 590,000. So this is 604,000 total income, right? Total income we say 604,000, 604,000, right? Here if you say add the this amounts 80 plus 80 plus 20 plus 12 minus plus 2.4, 194,400, right? Here you if you add 120,000 plus 15,000 plus 2,000 plus 6,000, 143,000, right? Here 12,000. Here if you say 22,000, right? All these amounts has to be deducted, right? Right? 604 minus 4.4 minus 143,000 minus 12,000 minus 22,000, then 232,600 is the gross profit. Gross profit equity, gross profit. You are adding this gross profit of how much? 232,000, 232,600 to the capital account, right? Plus 2,100,000 and 2,332,600, right? This is 100,000, right? Here if you say 230,000 plus 3,000 plus 50,000 plus 2,400 plus 20,000, then 305 and 400, right? 305.400, then plus 100,000 plus 230 to 2,332,600, right? Then we get 2,738,000, right? Right? Okay. Here again 1 million plus 560,000 plus 840,000, 2,400,000, 2,400,000, right? Here 90,000 plus 130,000 plus 100,000 plus 15,000, 335,000, right? 335,000. So 335 plus 2,400,000, 2,400,000, 2,735,000 comes. We will see what is the difference. Okay. Here we have taken the prepaid expenses, insurance prepaid, right? Prepaid, paid insurance is 3,000. Then this is 38. This is 38. 738. Okay, it is balancing. It is balancing. So if it is not balancing, check with the ledger balances. One of the ledger balances you may be omitted that one. So you add it. Check with the first of all with the ledger balances, and it will be okay. Otherwise it should be the casting differences. Okay. So we will meet you today. I am concluding my lectures here, and this lesson is over. And in next lesson also we are going to going to practice the questions, right? So then only you will be familiar with these adjustments. Okay, if you have any particular doubts, you can clear it. You can call me and clear it. Okay, thank you for joining with me. We hope to see you in next lesson. Thanks.